Good day, I'm Chartered, your accounting tutor. In today's video and class, we are still on end of accounting period adjustment. End of accounting period adjustment. And here today we're looking at allowances for discount allowable on account receivable. Allowances for discount allowable on account receivable. Discount allow, as you know, is an operating expense. Discount allow is allowance or the amount given out to customers as they make payment for the goods they are sold to. As customers make payment to goods sold to them, they are giving allowance. And most allowances given are cash allowance. But this is only done when payment is being made. And that is what is called discount. This is the amount set off the cost price or the selling price that is given to customers as they make payment on the goods sold to them. So, what is allowances? Here too, we are expecting that, the business expect that as time goes on, allowances will be given to customers. Allowances given to customers because that will be the culture of the business to give allowances to customers when they make payment. Most of the time, this type of allowances become a policy to the business that anybody that pays on social time should be given social allowance out the payment the customer made. So allowances are now known to the business. Then, as a result of that, they make provisions. They make provision that social amount that will be collected from customers will be given out as allowances to them, and that is what is called allowances for discount allowable. What formerly was called provision for discount allowable. So now, what do you mean by allowances for discount allowable on account receivable? This is the amount of money set aside, as I explained. The money is set aside after the profit made to provide for estimated cash discount allowable to customers who settle their debts within a stipulated period. You know, discount is mostly given to motivate or to encourage customers to pay on time. Because most customers, as they own, they end up not paying the business on time. And they hold the amount, thereby trying to stop the cash flow of the business. So, but when discounts are given, most customers are motivated to pay on time so that they will be able to get the discount. For example, if you are to make payment of 20,000 and you are giving discount of 2,000, it simply means that you have been given 2,000 off and you are going to pay only 18,000. It's a motivation. So most customers want to pay on time to be able to get that discount, which will be a reduction to the money they are paying, and it becomes a motivation. And then to the side of the business too, as the money comes in on time, that is earlier cash flow, they will also use it to put into other ventures to get more profit. And that is the reason for discount allowable or discount given. So in this case, after looking at the difference, let's look at the type. The treatment, how to treat allowances for discount allowable on account is almost the same, just not almost. It's the same thing with that of allowances on credit losses, which I've treated before. What you call provision for bad and doubtful debts. So the way you handled discount allowable is the same way you are going to treat provision for discount, for provision for bad and doubtful debt, or allowances for credit losses, as the new name connotes. So now let's look at it. The first one is the initial allowances made during the year or during the period or in the previous period. That is, from the previous period or during the year, the certain amount is expected to set aside out of the profit for the allowances that will be given to customers that will make payment on time. And then the next one is the current allowances made at the end of the accounting period. Now, previously, the businessman decided to make allowances that this is the amount they will be giving off the amount they are going to receive from customers. But at the year end, either the amount will increase or reduce, as the case may be, based on how the customers are being motivated to make payment, or based on how customers are being delayed to make their payment. So the discount are not always the same. The one that is made previously, either during the year or in the previous year, and the one that is just made at the end of the accounting period, which gives the real picture of how customers are responding to their payment. And that is why we have the initial one made during the year or the previous year, and then the one made at the end of the accounting period, which give the real picture of how customers have behaved till the end of the period. So that is why the first one is the initial allowance made during the accounting period of the previous period, or the current one made at the end of the accounting. This is what is the adjustment. This one comes at the end of the accounting period, and it is called adjustment. This one adjustment because it's already found in the trial balance, therefore it's not an adjustment. It has been adjusted or have already found the trial balance which passed through the double entry process, therefore it is not an adjustment. But the one that is given in the additional information, this current one that is made at the end of the accounting period, which is not included in the trial balance, become an adjustment. And in most questions, or in most questions that learners will come across, or in real life situation, this is the one that is common. This one is not common in question, though you can see it. But this is the emphasis is on the one that is given at the end of the accounting period. So let's look at this question here. We assume that the one that was already created during the accounting or in the previous period was 300. That they have provided 300 that will be given of the amount that we receive from customers. Then account receivable, mind you, both provision for that is allowance for credit losses and that of allowances are all on account receivable. That is the money that is expected to receive from customers that goods were sold to them. So now, this is the information that you are giving in additional information that the allowance is 2% on account receivable. Let's see how you work it out and how you use it appropriately. Now, you come and put your workings and say this is working. Workings on discount allowable. Then working one, you now say that allowances for discount allowable is 2%. With 2% means 2 over 100 times by 40,000. 40,000 is the account receivable. Whether it is mentioned or not, discount allowable and that of allowance for credit losses is strictly based on account receivable. Whether mentioned or not is based on account receivable. So 2% of 40,000 give you 800 naira. That means the current or end of accounting allowance is for discount is 800 naira. So in case where we have two allowances, the one given the trial balance, the previous one, and the one in the current year, you have to match it together to see the difference, just like what happened in allowances for expected credit losses. So here, first we take the current year. The current year, which is calculated, and you got 800 is here, and then the initial one that is given the trial balance during the year, there is 300. Then by the time you deduct 300 from 800, you have 500. So 500 now become an increase because the initial one was 300 and have been increased to 800. Therefore, the expenses, what we charge as expenses under profit or loss account is 500. So 500 become the expenses we incur. Mind you, this will be used under operating expenses as you solve your financial statement. Let's look at the accounting position of this. I told you that to incorporate this into ledger is to make sure that the ledger produce a balance brought down that will be used in the adjusted trial balance. So here, you open an account called discount allowable account. Then discount allowable account, the amount of the current year, the amount in the current year charged, the difference that we charge under profit and loss account will be debited. Why? Because it is an expenses. So for here, we have 500 naira. Then the 500 naira, which is the difference, which is what is to be charged in the profit or loss account. 500 now we charge the profit or loss. Mind you, it is not 800 that we charge, it is not 300, but the difference, that increase that we charge as expenses in the profit or loss account. Let's look at the next account, which is the corresponding of the where you have already created an expenses like this, which is a provision. Then you now create an account called allowances with this kind of allowable account. Then the corresponding entry that is debited here will now be credited in this account. But mind you, there will be a brought forward because there was initial allowances created during the year or in the previous year. So you have to bring it forward or introduce it as it was introduced either during the year, as the case may be. Then, but we believe that this was the one that was created in the previous year brought forward. Then we have 300 here. This is the previous. Then I take the one that was introduced in the current year, which is an addition of 500 naira. then 500 plus 300 will give you 800, meaning the new discount that will be allowed to customers is no more 300 but 800 by adding 500, which is an expensive because this one was already created and there's an addition of 500 based on the nature of how customers are paying. That means the expectation of the business now is that they will be allowing discount up to 800 naira. Then this becomes the balance carried down for that period, and then this becomes balance brought down. So this 800 by next year or next period or accounting period, it will serve as the one, just like the one you see in 300. It will appear in the new trial balance or the next trial balance that we prepared, because in the new one will no more be 800 but no more be 300 but 800. Mind you, I want to create a note here that is very, very important for you to understand. Here we are saying that allowances for discount allowable has the same treatment as that of allowances for expected credit losses or account receivable. I'm only emphasizing that if you're able to know how allowances for expected credit losses are treated in books of in financial statement, it is the same way and style and method that you use in treating allowances for this kind of, because all behave the same thing. If allowances if the difference is expenses, that of the allowances for expected losses, the increase is also expenses. If the increase, if there's a decrease, under allowances for expected losses are treated before is an income, here too it will be treated as income. That is why this note is important. So as you appreciate or understand how to treat allowances for expected credit, what we call provision for bad and doubtful debt, it is the same way you are going to handle allowances for discount allowable. So this is the treatment. But mind you, I'm going to also show you how it is treated in the statement of profit and loss account, and also how it is treated in the statement of financial position as we continue and complete the journey of how discount allowable are treated in the financial statement. Don't forget to like the video, comment and share, because that is how knowledge will be able to grow and flow, so that most learners will be able to understand how these adjustments are handled in financial statement. I remain Chartered, your accounting tutor.